Welcome to House Lux Estate, your one-stop channel for all things related to investing. Here at House Lux, we're dedicated to demystifying the world of finance, providing you with the tools and knowledge to make informed investment decisions. From real estate to stocks, from bonds to cryptocurrencies, we cover a broad spectrum of investment topics. Each one is fascinating as the next. But we're not just about providing information, we're about fostering a community of like-minded individuals eager to learn and grow their wealth. So, if you're interested in taking control of your financial future, consider subscribing. And don't forget to turn on the notifications. That way, you'll never miss an update on the latest investment opportunities. Together, we can navigate the often complex and unpredictable financial markets, turning challenges into opportunities. So buckle up and get ready for an exciting journey. In today's video, we'll be taking a deep dive into the world of commodities investing. First things first, what are commodities? Well, in simple terms, commodities are basic goods or raw materials that we use every day, which can be bought, sold, and traded on global markets. They are often the building blocks of other products that we consume. For instance, consider oil. It's a primary source of energy around the globe, used to fuel cars, heat homes, and generate electricity. It's also an ingredient in products like plastics and cosmetics. Oil, therefore, is a commodity. Or take gold, a precious metal. Gold is used in making jewelry, in electronics due to its excellent conductivity, and as a store of value. Gold has been a symbol of wealth for centuries and continues to be a significant commodity today. Then there's wheat, a staple food crop. Wheat is used to produce a variety of food products from bread to pasta and is traded globally. It's a commodity that's essential for our daily sustenance. And let's not forget about livestock such as cattle. Cattle are reared for meat, milk, and leather, among other things, making them a key commodity in various industries. So when we say commodities, we're referring to these kinds of tangible assets. But it's not just about physical goods. In the financial world, commodities also include things like foreign currencies and financial instruments. The common thread is that these are all standardized products. Regardless of where you buy a barrel of oil or an ounce of gold, the quality is generally the same. This standardization allows commodities to be traded on exchanges, just like stocks and bonds. Importantly, commodities play a crucial role in the global economy. They are fundamental to industries and sectors worldwide, from agriculture and energy to manufacturing and construction. Now you might be wondering, why is any of this relevant to investing? Well, commodities offer a way to diversify your investment portfolio beyond traditional securities like stocks and bonds. They can also act as a hedge against inflation and market volatility. Now that we know what commodities are, let's explore why they are an important part of an investment portfolio. Commodities might seem like an unconventional investment, but they hold great significance. Diversification is a key principle in investment, and commodities offer just that. By spreading your investments across different asset classes, such as stocks, bonds, and commodities, you can minimize risk and potentially optimize returns. Commodities can also provide high returns. Gold, silver, oil, wheat. These are all commodities with prices that can rise significantly in a short period of time, presenting an opportunity for high profit. Moreover, commodities play a crucial role as a hedge against inflation. When the cost of living rises, so does the price of commodities. It's a natural balance that can protect your investment. If your money is tied up in commodities when inflation hits, your portfolio won't lose its value because the price of your commodities will rise in tandem with the inflation rate. Now that we understand their importance, how does one go about investing in commodities? Scene 4 sets the stage for the practical part of your journey into the world of commodities. Investing in commodities can be done in various ways. Each method has its own unique characteristics, benefits, and risks. Let's get started, shall we? First on our list is investing in commodity futures. This is an agreement to buy or sell a specific amount of a commodity at a fixed price, to be delivered and paid for at a later date. It's like making a promise to buy or sell something in the future. The allure of futures lies in their potential for high returns. However, they require a deep understanding of market trends and can be risky due to the volatility of commodity prices. It's like sailing in stormy seas. You can reach your destination faster, but you need to be an experienced sailor to navigate the rough waters. Next, we have commodity exchange traded funds, or ETFs. These are investment funds traded on stock exchanges, much like individual stocks. They aim to track the performance of a specific commodity or group of commodities. ETFs offer a simpler and less risky way to invest in commodities compared to futures. They provide diversification as they often hold a range of different investments. It's like having a basket of different fruits instead of just one type. However, the performance of ETFs depends on the fund manager's skills and the overall performance of the commodities they track. Lastly, investing in physical commodities is the most direct way to invest. This means buying and holding a physical commodity like gold bars, oil barrels, or bags of coffee beans. The advantage here is that you own a tangible asset that you can sell later, hopefully at a higher price. However, storing and insuring physical commodities can be costly and challenging. It's like owning a classic car. It can be valuable and rewarding, but you need to maintain it and keep it safe. In summary, commodity futures can offer high potential returns but require market savvy and risk tolerance. Commodity ETFs provide a simpler, less risky way to tap into the commodities market, but their performance relies on the skills of the fund manager and the commodities they track. Investing in physical commodities gives you direct ownership of a tangible asset, but the costs and challenges of storage and insurance can be significant. Each method has its own appeal depending on your investment goals, risk tolerance, and the resources at your disposal. Some investors may prefer the thrill and potential rewards of futures, while others may prefer the simplicity and diversification of ETFs. Still, others may appreciate the tangibility of physical commodities. Investing in commodities can seem daunting, but with the right knowledge and strategy, it can be a rewarding venture. Remember, investing is not a one-size-fits-all game. It's about finding the right fit for you. So take the time to understand these methods, weigh their pros and cons, and choose the one that suits you best. Like any investment, commodities come with their own set of risks and rewards. Let's dive right into the heart of this matter. First, let's talk about the potential risks. The commodities market is known for its volatility. Prices can fluctuate wildly in a short period of time due to factors such as weather, political unrest, or economic indicators. For example, a poor harvest can cause grain prices to skyrocket, while geopolitical tensions can lead to a spike in oil prices. This volatility can lead to significant losses if you're not careful, and it's one of the main reasons why commodities are considered a risky investment. Another risk is the geopolitical factor. Commodities are often produced in countries with unstable political environments. Any sudden change in a country's political climate can drastically impact the supply of a commodity, causing prices to swing unpredictably. This makes commodities a high-risk investment that can sometimes be akin to a game of high-stakes poker. Now, let's shift gears and talk about the potential rewards. One of the biggest draws of investing in commodities is the possibility of high returns. If you can accurately predict market trends, you stand to make a substantial profit. Commodities also offer a hedge against inflation. When the cost of living rises, so do commodity prices, providing a buffer against inflationary pressures. Additionally, commodities can provide an excellent way to diversify your investment portfolio. Because commodity prices often move in opposition to stocks, they can help balance out your portfolio during times of stock market volatility. Lastly, investing in commodities can also provide a sense of satisfaction. Knowing that you're investing in tangible goods like gold, oil, or wheat can add a unique dimension to your investment strategy. Investing in commodities can be a roller coaster ride, but the thrill is part of the journey. Remember, every investment comes with risks and rewards. It's all about understanding and managing them to your advantage, so buckle up and enjoy the ride. We've covered a lot of ground today, so let's quickly recap. We began by defining commodities as basic goods used in commerce that are interchangeable with other goods of the same type. We then discussed their importance in investment, highlighting their role as a hedge against inflation and a means to diversify portfolios. Next, we delved into how to invest in commodities. We explored various avenues such as futures contracts, commodity ETFs, and stocks in commodity companies. Each method has its pros and cons, so it's crucial to consider your risk tolerance, investment goals, and market knowledge before diving in. Finally, we talked about the risks and rewards of investing in commodities. While the potential for high returns is attractive, it's essential to remember that commodities can be highly volatile and losses can be significant. Thank you for watching. Remember to subscribe to House Lux Estate for more investment insights. Until next time, happy investing.